Warren Buffett is an American business magnate, a philanthropist, and an active investor. He is currently the chairman and CEO of Berkshire Hathaway, which owns more than 60 companies, including insurer Geico, battery maker Duracell, and restaurant chain Dairy Queen. He is the son of a U.S. congressman. He first purchased stock at the age of 11 and first filed taxes at the age of 13. Warren Buffett approached his first million by running a hedge fund. Then he further switched to owning several small banks. After some time, he shuts down his hedge fund and put all his money into running an insurance company. The insurance company is a hedge fund that keeps all the money of Warren Buffett and owns 100% of the profit. Do you want to know how Warren Buffett invests in 2021? You're at the right place in this video. We will share with you the most important investment advice from the man himself. So let's begin. No matter how much money any billionaire owns or how much their annual salary may be, most millionaires invest their money where it will grow, generally in bonds, stock market shares, and other types of stable and secured investment. Millionaires put their money to become billionaires where their money will nurture, such as stocks, mutual funds, and retirement accounts. Unlike other business investors, Warren Buffett doesn't advise other people to follow his strategy of making money. Being an active business investor, he has grown his assets by purchasing multiple businesses at discounted prices and analyzing them individually. If anybody wants to know how to make money like Warren Buffett, one can consider some essential footsteps of Warren Buffett. His strategy of investing and making money is based upon waiting and waiting and waiting for a long time, and then finding a right fruitful opportunity. At a perfect time when he finally has a break to buy any business at reduced prices, he buys it in bulk stocks. After buying that business, he runs the business and gets profit for decades and decades. Also again waits for a perfect time to sell it. This strategy leads him to purchase many of the big projects like Bank of America, American Express, Apple, and Coca-Cola. These massive businesses have been proved to be very fortunate for Warren Buffett. But the real secret of his worth is not essentially his business strategy, but his investing temperament. According to an interview of Warren Buffett, some people should not buy stocks because they just get too upset with price fluctuations. If you're going to do dumb things because your stock goes down, you should not own a stock at all. Here, Warren Buffett also quotes an example to clarify, like if you buy a house for $20,000, and someone asks you to sell it for $15,000, but you don't sell your house because he quotes $15,000. This is not recommended at all. It's been idiotic to own long bonds, and one should be educated enough to have an idea. Most of the people are not emotionally and psychologically attached with their stocks, but they must be well aware of what they are buying as well as how and when to sell it. Warren Buffett is one of the most active and experienced business investors, and he suggests that if someone has not right and essential temperament for business, he should not invest in stock market. This approach of temperament and waiting for a perfect opportunity may be much dodgy, but this is what the most important parameter is in the stock market. Even many of the businessmen who lose their money in the share market is not because they don't find any good business to invest, but the main reason is their strategy to point out a right opportunity. Several people find very good businesses to buy and sell, but end up losing money being influenced by their emotional attachments and lose a fine opportunity to invest or sell a business at absolutely a wrong time. If someone finds himself a human who cannot keep his emotions out of the business or his stock investment, he can purely go for a passive investment through ETF index funds, which are a very good mode of investments from a past few decades. Each transaction or investment represents the diversification in the whole stock market, so it is better to remain in the market and being dynamic for buying and selling each year. This practice ensures complete evacuation of your psychological attachments from business, and the investor is not awaiting the right time to buy or sell for the long period of time. Instead, he just keeps himself active in the market. Warren Buffett quotes one of his experiences from 1942 when he bought his first investment as an illustration. There were 14 presidents, 7 Republicans, and 7 Democrats. There were many of the mishaps like World War, 9/11 attacks, and 2 of the missile crisis. Above these, all the best thing was to buy an investment which was an index fund. He never looked at any headline who was the share market going and what can be expected with the prices. Investors should only believe, and this is what he did, that America will win the World War and America will continue to go at the track of progress as from 1776. When America will go up, automatically the business will go up. This is not the thing to worry about. What to buy and what to sell, as well as the impeccable prospect. Warren Buffett suggests this strategy to other younger entrepreneurs and businessmen also to make up the right mindset. You did not have to worry about what stock to buy, you did not have to worry what day to get in and out. First thing is the right time to get in, and the second important phenomenon is to wait for enough time for the magic to happen. These two are the things eventually required for a success. For example, from some past census, there was a time period when market performed nothing positive from 1966 to 1978. There was a zero for more than 10 years. If this consideration is further proceeded for another time period of 10 years, this same stock market, which previously showed a zero return, shows a 187% return, along with a compound annual growth rate of 55. This is the way how this dollar cost averaging journey works. Warren Buffett states in one of his addresses that I am talking specifically to that point, so I would pick a broad index, but I wouldn't toss a chunk in at any one time. I would do it over a period of time because the very nature of index funds is that you're saying, I think America's business is going to do well, reasonably well, over a long period of time, but I don't know enough to pick the winners and I don't know enough to pick the winning times. There's nothing wrong with that. I don't know enough to pick the winning time occasionally, but I think I know to pick a winner, but not very often. The conclusion is just that if you have a good feeling or vibes that these businesses have potential to perform remarkably, place a heavy investment for a longer period of time and you are good to go under the certain circumstances. Well, there you have it. If you enjoyed this video, do leave a like and subscribe to the channel. Also, if you want to see more, press the bell icon so that you get VIP access to our future videos. Thanks for watching, and with that said, we look forward to seeing you in the next video.